A simple experiment across 9 coin shops revealed something Wall Street doesn't want you to know. When silver hit $90 per ounce, dealers offered $70, some even less. What they said next exposes the real crisis in precious metals markets. Silver is trading at $90.41 per ounce. For investors watching spot prices, this represents a staggering milestone. But here's the question. No one in mainstream financial media is asking, what happens when you actually try to sell physical silver at that price? The answer reveals a disconnect so severe it exposes fundamental cracks in the precious metals market that most investors never see until it's too late. On January 17, 2026, with silver futures showing $90+ per ounce, an experiment was conducted. Not a theoretical exercise, not a spreadsheet analysis, a real-world test involving 9 coin shops across the United States. The objective was simple. Call these dealers and ask what they would pay for standard 1-ounce silver rounds and American Silver Eagles. The hypothesis seemed straightforward. If spot silver is trading at $90, dealers should offer something close to that price, minus a reasonable markup for their service and overhead. Perhaps $85, maybe $82, even $80 would represent a fair market transaction. The reality was far different. And it reveals something critical about the physical silver market that every investor needs to understand before making their next move. To understand why this matters, consider what happened just 3 months earlier. On October 27, 2024, silver was trading at $46.76 per ounce. Take that number and double it. The result is $93.52. Silver hasn't just risen, it has nearly doubled in less than 90 days. This isn't normal market behavior. This is a parabolic move that historically signals either a fundamental shift in market dynamics or an unsustainable spike that precedes a violent correction. Coin dealers know this. They've seen it before in 1980, in 2011, and in smaller cycles throughout the past decades. When an asset doubles in 3 months, professionals in that market don't celebrate. They brace for impact. Because what goes up that fast can come down even faster. And when you're a coin shop sitting on physical inventory purchased at various price points, a sudden $20 or $30 crash in spot price doesn't just hurt your profit margins. It can wipe out your entire operation. This is the context for what happened next. This is why the experiment matters, because it reveals the gap between paper silver prices and physical silver reality. A gap that retail investors, watching their portfolios climb on brokerage screens, have no idea exists. The methodology was deliberate. 9 coin shops were contacted by phone. Each was asked the same question: what are you paying today for 1-ounce silver rounds and American Silver Eagles? The shops were located across different U.S. markets to capture a representative sample. No names were provided to protect dealer identities, but the data was recorded with precision. 2 shops stood out immediately. One offered the best prices. The other offered terms so unfavorable they skewed the entire average. Both calls were recorded. The audio reveals something more important than just numbers. It reveals the psychology of dealers who work on the front lines of physical precious metals markets every single day. These aren't Wall Street analysts making predictions from Manhattan offices. These aren't COMEX traders moving paper contracts. These are the people who actually exchange cash for physical metal. They see what retail investors are buying. They know what institutional buyers are demanding. They feel the market in ways that spot prices can never capture. And right now, in January 2026, with silver at $90+ per ounce, they are saying something very specific through their buy prices. They're saying, we don't trust this rally. They're saying, we expect a pullback. They're saying, if you want to sell us your silver today, we need a massive cushion to protect ourselves from what might happen tomorrow. The question is whether they're right. The bigger question is what this means for the millions of Americans holding silver as a hedge against inflation, currency debasement, and economic instability. The data from those 9 phone calls tells a story. But before revealing the numbers, it's important to understand what they represent. This isn't just about dealer spreads. This is about the health of the physical silver market itself. The results from calling 9 coin shops revealed a market reality that contradicts everything retail investors see on price charts. Starting with silver rounds, the most common form of investment-grade physical silver, the offers ranged from concerning to catastrophic. The best shop contacted offered $6 back of spot. That means with silver at $90, they would pay $84 per ounce for standard rounds. Not ideal, but within reason for a dealer who needs to cover overhead, make a profit, and protect against short-term price volatility. The second-tier shops came in at $7 back of spot. 2 shops offered this price. At $90 silver, that translates to $83 per ounce. Still a meaningful gap, but not unreasonable, given the rapid price appreciation and uncertainty in the market. Then the numbers started getting worse. 2 shops quoted $9 back of spot. One shop specifically stated they were paying 10% back of spot, which at $90 silver equals roughly $9 under, or $81 per ounce. Another shop came in at $10 back, offering $80. One shop quoted $12 back of spot. At $90 silver, that's $78 per ounce. A $12 discount represents more than 13% below spot price. For investors who purchase silver at $80 or $85, selling to this dealer would mean taking a loss despite silver's overall upward trajectory. But none of this prepared for what the worst shop offered. When asked about buying silver rounds and silver eagles, the response was blunt. $70 today. $70 per ounce. With spot silver at $90. That is $20 back of spot. More than 22% below market price. This wasn't a negotiation. This wasn't an opening offer meant to be countered. This was the final price. Take it or leave it. The dealer didn't differentiate between rounds and silver eagles. Everything was $70. To understand how extreme this is, consider the math. The shop at $6 back was offering more than double the spread of the 10 back shop. But the $20 back shop was operating on an entirely different level. They were pricing in a scenario where silver could collapse by $20 or more in a matter of days or weeks. For American Silver Eagles, the premium coins recognized by the U.S. government, the numbers improved slightly but still revealed significant dealer caution. The best shop offered $3 back of spot. At $90 silver, that's $87 per ounce for Silver Eagles. Better than rounds, reflecting the higher demand and liquidity for government-minted coins. 4 shops, nearly half of those contacted, offered $5 back for Silver Eagles. At $90, that's $85 per ounce. One shop came in at $6 back, $84. Another at $4 back, $86. And one shop matched its round pricing at $8 back, offering $82 for Silver Eagles. Again, the outlier was the $70 shop. No premium for Eagles. No recognition of the government backing or higher collector demand. Just a flat $70, same as rounds. When the averages were calculated, the story became even clearer. Excluding the worst shop, the 8 remaining dealers averaged 8.75 back of spot for silver rounds. At $90, that equals 81.25 per ounce. For Silver Eagles, the average was 5.12 back, or approximately 84.88 per ounce. Including the worst shop, those averages dropped dramatically. Silver rounds fell to $10 back on average, and Silver Eagles to $6.77 back. What does this mean for investors? It means the spot price on your screen is not the price you'll receive when you sell. It means the value of your silver stack is theoretical until you find a buyer. And it means that in a market moving this fast, dealers are building in massive protection because they've seen what happens when euphoria turns to panic. The phone call with the best dealer was straightforward and professional. The call with the $70 dealer was revealing in a different way. There was no hesitation, no apology, just a simple statement of fact. He's offering $70 today. That phrase, today, carries weight. It implies tomorrow could be different. It suggests prices are fluid, unstable, subject to change based on factors beyond any individual dealer's control. This is the physical silver market in January 2026, and it's telling investors something critical about what lies ahead. The question every investor should be asking is simple. Why are coin dealers offering $20, $12, even $9 below spot price when silver is climbing to multi-decade highs? The answer lies in what happened less than 3 months ago, and what history teaches about parabolic price moves in precious metals. On October 27, 2024, silver was trading at $46.76 per ounce. By mid-January 2026, it had nearly doubled, a 92% gain in under 90 days. For context, silver's average annual return over the past 20 years is approximately 6% to 8%. What happened in those 3 months represents more than a decade of typical gains compressed into a single quarter. This is not normal, and coin dealers know it. When an asset moves this aggressively, 2 scenarios are possible. Either the fundamentals have shifted so dramatically that the old pricing models no longer apply, or the market is in a speculative bubble that will correct violently. Dealers don't have the luxury of waiting to find out which scenario is playing out. They have to price in the worst-case outcome because their survival depends on it. Consider the mechanics of how coin shops operate. They purchase physical silver from retail sellers and hold that inventory until they can sell it to other buyers, either retail customers or larger wholesalers. During that holding period, which can range from days to weeks, they are exposed to spot price fluctuations. If a dealer pays $85 for silver rounds when spot is at $90 and spot drops to $75 before they can resell, they've just taken a $10 loss per ounce. Multiply that across hundreds or thousands of ounces, and the losses become catastrophic. This is why dealers build in wide spreads during volatile markets. But there's another factor at play. Dealers aren't just protecting against normal volatility. They're protecting against the possibility of a silver crash triggered by factors completely outside their control. Silver's recent surge has been driven by multiple converging forces: declining COMEX inventories, industrial demand from solar panels and electric vehicles, central bank gold buying spilling over into silver, retail investor FOMO as prices break through resistance levels, geopolitical tensions driving safe haven demand. But every one of those drivers can reverse overnight. A recession could crush industrial demand. A stock market rally could pull speculative capital out of commodities. A coordinated effort by bullion banks to suppress prices through paper contracts could break the rally. Coin dealers have seen this before. In 2011, silver hit $48 per ounce before collapsing to $20 in a matter of months. Dealers who overpaid for inventory during that peak were wiped out. Some never reopened. The survivors learned to never trust a parabolic move. This is the institutional memory that shapes dealer behavior in 2026. When silver doubles in 3 months, alarm bells sound. When retail investors start calling to sell, dealers know what's coming next. Either the sellers are taking profits before the crash, or they're in financial distress and need cash regardless of price. Either way, it signals a market top. The $70 dealer, the one offering 22% below spot, is pricing in a scenario where silver drops back to $60 or $50. At those levels, $70 inventory would still leave them with a loss, but a survivable one. If silver holds at $90, they sacrifice profit margin. But if silver crashes, they stay in business. This is risk management in real time. And it reveals something critical about the nature of physical silver markets that paper silver traders never experience. COMEX contracts settle in cash. ETFs trade with the click of a button. But physical silver requires someone on the other side willing to hand over currency in exchange for metal. And when that someone is a coin dealer with overhead, employees, and business risk, they don't care what the spot price says. They care about what happens next week. The average investor watching silver climb assumes selling will be easy. Just walk into a shop, show your stack, and walk out with cash at or near spot price. The reality is far different. The reality is $70 offers when spot is $90. The reality is 8 to 12 hour spreads even at reputable shops. The reality is that physical silver, unlike paper contracts or ETFs, has a liquidity problem that only becomes apparent when you try to exit. This is what coin dealers know that most investors don't. And it's why their buy prices are telling a story about the market that spot prices refuse to acknowledge. The disconnect between 90 spot silver and $70 dealer offers exposes a fundamental truth about precious metals investing that most Americans never confront until it's too late. Paper prices and physical reality exist in different worlds. For investors holding silver as a hedge against inflation or currency debasement, this matters enormously. The value of your stack is not what your portfolio tracking app shows. It's not what COMEX futures indicate. It's what a dealer will hand you in cash when you walk through their door. And in January 2026, with silver at all-time nominal highs, that number is significantly lower than most investors expect. There are 3 critical takeaways from the 9-shop experiment that every silver holder needs to understand. First, spot price is a reference point, not a guarantee. The $90 figure represents where paper contracts are trading, where futures settle, where ETFs price shares. But physical silver operates in a different market with different dynamics. Premiums, dealer spreads, liquidity concerns, and risk management all create gaps between spot and actual transaction prices. This gap widens during volatile periods. When silver is stable at $22 or $24 per ounce, dealer spreads might be $2 or $3. Manageable, predictable. But when silver doubles in 3 months, uncertainty explodes, and spreads widen to $10, $15, even $20. This is the cost of volatility in physical markets. Second, not all silver is created equal. American Silver Eagles commanded a premium over generic rounds in nearly every shop contacted. The best shop offered $3 back for Eagles versus $6 back for rounds, a $3 difference per ounce. For investors holding 100 ounces, that's $300 in additional value simply from owning government-minted coins instead of private rounds. This premium exists because Silver Eagles are more liquid, more recognizable, and more trusted. Dealers can resell them faster and at higher margins. When markets turn unstable, that liquidity premium becomes even more valuable. It's insurance against getting stuck with inventory no one wants to buy. Third, timing matters more in physical silver than in paper silver. In paper markets, you can sell instantly at the prevailing bid price. In physical markets, you need to find a buyer willing to hand over cash. And when dealers are offering $70 for $90 silver, it means they believe a correction is coming. This doesn't mean they're right. Markets can stay irrational longer than dealers can stay solvent. Silver could continue climbing to $100, $110, even higher. But it does mean that professionals with real money at risk are positioning defensively. For investors deciding whether to sell into this market, the calculus is complex. Selling to a dealer means accepting a significant discount. The best offer found was $6 back for rounds, $3 back for eagles. That's $84 and $87 respectively at $90 silver. Workable, but painful if you believe silver is headed higher. The alternative is selling privately. Online marketplaces, local meetups, peer-to-peer transactions. These can yield better prices, often at or above spot. But they come with risks. Counterparty risk, safety concerns, time and effort. For some investors, that trade-off makes sense. For others, the convenience and security of a dealer transaction justifies the discount. There's also the question of whether to sell at all. Many silver investors view their holdings as long-term wealth preservation, not short-term trading vehicles. For them, a $90 spot price is irrelevant. They're holding for $150, $200, or until the monetary system fundamentally breaks. But not everyone has that luxury. Financial emergencies happen. Unexpected expenses arise. And when they do, knowing what your silver is actually worth, not what spot price suggests, becomes critical. The final lesson from calling 9 coin shops is this. The physical silver market is not as deep or as liquid as most investors assume. Wide spreads, cautious dealers, and massive discounts during volatile periods reveal structural weaknesses that paper markets hide. This doesn't make silver a bad investment. It makes it an investment that requires understanding what you actually own and what you can actually get for it when the time comes to sell. In January 2026, with silver at $90 per ounce, the answer is clear. Expect $80 to $87 if you're lucky. Expect $70 if you're not. And understand that the dealers offering those prices know something about precious metals, markets that spot prices will never reveal. The question is whether you'll listen before it's too late.